Hello and good afternoon, everyone. Thank you very much for coming to today's webinar with the second half in the series of Outlook for 2022. A couple of housekeeping items for those of you that are new to this presentation. My name is Christina Cuprina, Chief Economist, as well as a number of other roles at Sequoia Wealth Advisors. And we do these webinars roughly once a month to kind of give some updates on where we see the economy going. We touch upon a number of different factors. However, to keep it in fun and exciting and engaging, please don't hesitate to send in your questions. Today we have a special guest who I'll be introducing shortly. But before doing that, I wanted to say that because of our special guest today, I'm going to have about a half an hour to speak, so I won't be able to cover all of the things for 2022. I'll keep the most important highlights in today's webinar. And then after that, I will go ahead and do a more detailed deep dive into this in January. Again, thank you everyone for attending. So in a moment, I'm going to introduce someone who many of you have heard to speak before. He is the chief economist, or one of the chief economists at First Trust. He's our Washington expert. He spoke at this webinar previously around the election season. Right, so he's over there, he's on the East Coast, he's heading into his evening, and he's going to be with us today to give their take on outlook for the economy of 2022 and cover a lot of what's going on in Washington right now. He'll be the first 30 minutes or so, and then I'm going to pop in after that and give you my updates as well. So send in your questions as they arise. A thank you for everyone who sent their questions in advance. And with that being said, I'm going to go off video, and I'm going to let Bob Stein take over for a moment.
Thank you very much. Everybody should be able to see my presentation, hopefully by now. I'm sharing it up on the screen. Just by way of background, I've been with First Trust for 15 years as an economist. Before that, I spent 4 years at the U.S. Treasury Department, finishing up as Assistant Secretary for Macroeconomic Policy. And before that, I spent 7 years on Capitol Hill, the last 2 as the Chief Economist for the Senate Budget Committee. What I'm going to be talking about this afternoon is what's going on in Washington, D.C. and the state of the economy. I want to tell you, though, up front, when I talk about politics, I am not here to talk about what I, Bob Stein, would personally like to see happen over the next few years. I'm going to talk about what I think will happen instead, whether I like it or not. In terms of what's going on in Washington, D.C. right now, all eyes are on whether or not the Democrats can pass a Democratic-only spending and tax plan called Build Back Better that the Biden administration has proposed. Here's the deal. At the very beginning of this year, I thought there was about an 80% chance that this bill would pass in some form or another. Now, I think it's a little bit less than 50%. It wouldn't shock me if the Democrats were able to pull a rabbit out of the hat and get it enacted very late this year or early next year. But as of now, I'm a slightly less than 50%. Big change from where I was almost 12 months ago. I will talk in a moment about what any tax hikes would look like if a bill gets to the president's desk. But for now, I'd like to talk about some other policy issues percolating in Washington, D.C. One issue is the minimum wage. The progressive wing of the Democratic Party wants to see a $15 minimum wage. They want to see it now. However, in my opinion, they're not going to see $15, and they're certainly not going to see it now. My best guess is that sometime in the spring of next year, Republicans and Democrats will come together on a compromise bill to raise the minimum wage to something on the order of $11 or $12 an hour, but phased in gradually over a couple of years, not 15, and not in one fell swoop. In terms of trade conflicts, we saw a lot of trade conflict between the Trump administration and foreign governments around the world over the previous 4 years. Under the Biden administration, it's going to be a little different. I think they're going to be much more accommodating for foreign governments. The one major exception will be China. We saw 24 years of trade accommodation with China, bipartisan, under President Clinton, President Bush, and President Obama. That changed under President Trump, and that will remain a more hostile relationship than it was before President Trump took office, even under Joe Biden and whomever gets elected afterwards. In terms of big tech, my theme for the Biden administration is very simple. Lots of barking, very little biting. Now, that doesn't mean zero biting, but I think the bites will really be nibbles more than anything else. I do expect a slowdown in merger and acquisition activity in big tech. I think antitrust enforcement will be a little bit tougher, but I also expect a slowdown in merger and acquisition activity across the entire United States economy, not just big tech. In addition, I expect bipartisan legislation to regulate social media enacted next year. Here's the dirty little secret in Washington, D.C., though. The big players in social media actually want more regulation. I know that sounds odd, but here's the reason. The more regulation they have, the easier it is for them to defend their market share against upstart companies and other companies as well that are not yet in social media. So it's real, more social media regulation is really incumbent protection more than anything else. The reason I don't think the Biden administration will in any significant way bite the hand of big tech is because if you look at the political donations coming from big tech, be they Facebook, Microsoft, Google, Amazon, Apple, they are overwhelmingly in the direction of the Democratic Party. The Democratic Party is not run by fools or idiots, so they're not in any significant way going to bite the hand that feeds them. In terms of environmental rules, or what I call green regulations, I want you to think in terms of 3 different buckets for environmental rules over the next few years. Bucket number 1, this is where the Biden administration is going to make some changes, and there is nothing the Republicans can do to stop him. An example of this is raising the automobile mileage fleet standards for US cars and trucks. It's going to happen. The CAFE standards will be raised. Nothing the Republicans can do to change that. Bucket number 2, these are areas where the Biden administration is making changes, but it's really not having a big effect on the energy market just yet. An example of this is slowing down the process for new leases for drilling and extracting fossil fuels on federal land. It is true the Biden administration has already made that change. It is true that energy prices are up significantly this year. So the Republicans are pointing to the change in policy and the rise in energy prices. They're saying, hey, it's obvious. Let's put 2 and 2 together. We get 4. However, I believe the price rise in energy would have happened anyhow. The Trump administration was giving away these leases like they were going out of style in 2019 and 2020. So yes, the slowdown has occurred for new leases, but it's really going to take a few years to bite the energy market. Bucket number 3 is a little more complicated. I believe that the Biden administration is going to issue a lot of new rules over the next few years that make it harder for utilities to burn fossil fuels to generate electricity, and make it harder for drillers and extractors to get fossil fuels out of the ground across the entire United States, not just on federal land. However, I believe there is now a Supreme Court majority to overturn something called the Chevron decision from the mid-1980s. The Chevron decision, which dates back to 1984, Chevron, like the oil company, basically said that if federal regulators issue new rules, that the courts are going to have a light touch. They're not going to strictly scrutinize those new rules. They're basically going to assume the regulators knew what they were doing. If they overturn the Chevron decision, the court will have an opportunity to impose a much stricter level of scrutiny on new federal regulations. For example, they could say that if regulators come out with new rules, if those regulators are then challenged in court, that the regulators have to show specifically where Congress passed a law giving those particular regulators the authority to issue that particular set of rules. So much a stricter level or higher level of scrutiny. And I think many of the environmental rules coming from the Biden administration over the next couple of years are going to fail that test. In terms of tax changes, I want to remind you, I think there is at best, so a 50% or minus chance, 50% or less chance that any tax changes are enacted anytime soon. In other words, all of the tax changes I've been talking about all year, that at the beginning of this year I thought were going to happen, I think there's less than a 50% chance this happens. There's less than a 50% chance a tax bill, Build Back Better, gets to Joe Biden's desk. But let's talk about what's going to happen just in case Biden gets to sign a change in tax laws. First thing I want you to know is I don't think any part of the tax hike would be retroactive to January 1st or any other part of 2021. I think they'd be effective January 1st of 2022 instead. Right now, we have a top tax rate of 37%. Some members of the House, in fact, the House passed a bill that would raise the top rate on the very highest earners to 45%, but I don't think that's going to happen. And here's why. If you're in New York City or California, your top rate would be 45 federal, essentially 13 state and city for New York City, and then another 3.8 percentage points Medicare, essentially a 62% marginal tax rate. In the end, I don't think Chuck Schumer is going to allow his strongest donors in New York City to be hit with that high a marginal tax rate. So he'd vote for it if it gets to the floor, but as majority leader, he's going to work overtime to make sure it never gets to the floor in the first place. If the Democrats raise the top tax rate, I think the highest they would go would be 39.6%. Now, 39.6% should ring a bell. That's exactly where it was for 8 years under Bill Clinton, the last 4 years under President Obama, and the first year under President Trump. And 39.6% had two things in common. That 13-year era had a bull market in stocks and not one recession during any of those 13 years. However, I don't think 39.6% is magic. You can't just move to 39.6% and prevent bear markets and recessions. So I'm not saying you can't have a bear market or recession at 39.6. I'm just saying that 39.6 by itself will not cause one. In terms of the corporate rate, we had 35% for a generation before President Trump took office. He took it to 21%. The highest we'll go is 25%. We may stay at 21%, even if Joe Biden gets to sign a tax hike. So to me, that's a glass half full. If I could have imagined 3 years ago that the Democrats would control the House, the Senate, and the White House today, I would have assumed we'd go higher than 25%. The fact that there were somewhere between 21 and 25% for the corporate rate, I think that's a glass half full and not empty. In terms of the SALT cap, right now we have a limitation of $10,000. I think if a bill gets to the president's desk, they raise it to something like 20 or 25,000 instead. In the alternative, they might raise it higher, but then they'd claw back some of that benefit by limiting the value of the deduction to maybe 15% of taxes of the state and local taxes paid. So they'd reduce the value of the deduction for upper income taxpayers relative to lower income taxpayers. In terms of capital gains and dividends, the Biden administration originally proposed 39.6%. That's not going to happen though, okay? Right now, the statutory tax rate, the highest one on capital gains and dividends for the highest earners is 20, plus we have a 3.8% Medicare tax. So essentially we have a tax rate all in of 24% on the top earners in the United States on capital gains and dividends. What I think the Democrats might do is raise that 20 to 24, which means the all-in rate becomes 28%. Now 28% should ring a bell from the distant past. 32 years ago, that's exactly where the rate, or 33 years ago, that's exactly where the rate was in January 1989 when Ronald Reagan left office. So it would put the Democrats in a position where they could say, if it was good enough for Reagan, it should be good enough for us today. In terms of other changes, the Biden administration wanted to get rid of the step-up basis of death. That's not going to happen. They're going to keep the step-up basis of death. And that means if you inherit stock or other assets, when you go to sell it, you'll only pay taxes on the gain that occurred after you inherited that asset. What I think they do instead of getting rid of the step-up basis of death, which by the way has been the law of the land in the United States for the past 100 years, is reduce the estate tax exemption. Right now, this year, it's 11.7 million, I think. It's going up a little above 12 million next year on schedule. I think they end up reducing it to 6 or 7 million instead. That would be a little bit higher than the 5.5 million that prevailed before President Trump took office, but clearly lower than today. But that gives policymakers a way of raising revenue from people who inherit assets without causing the administrative nightmare that would ensue if they get rid of the step-up basis of death. Many people have no idea what their parents or grandparents originally paid for an asset. In terms of politics future, the way I see it today, and this may change over the course of the year, is that the issue isn't really whether there's going to be a wave in the Republicans' direction or not next year. It's going to be whether there's a wave or whether there's going to be a tsunami. I think the Republicans have a 95% chance of taking over the House next year. Democrats already have razor thin majorities in the House. So the Republicans gain about 5 seats. They'll take over the House, historically speaking. That would be small for an out party, a party that does not control the White House. Usually the midterm history is that the party that does not control the White House does quite well. When I look at state legislative races around the country in 2020, I noticed Republicans did well. That was same year they lost the presidency. They did well in state legislative races, which means they hold the pen on drawing where those district lines go around the country. In addition, if I look at the Virginia races, gubernatorial and state legislative races, same thing for New Jersey, a judicial race in Pennsylvania this past November. I'm looking at a lot of momentum in the Republican direction. So I think they're 95% chance again to take the US House. I also make them favor to take the Senate, but only 75%, not 95%. So what's the deal here? Why is it 75 rather than 95? Really 2 reasons, okay? The Democrats only have to defend 14 Senate seats this time around. Look at the math. There are 435 House seats. A majority are Democrats and a majority, and all of those seats are up for grabs next year. So that gives the Republicans a lot of seats to shoot at to try to gain the majority back. In the US Senate, there are 100 seats, but those are 6-year terms. There are only 34 Senate races. Among those 34, Republicans already occupy 20 of those seats. Democrats only occupy 14. So that simply gives the Republicans fewer seats to shoot at to try to get the majority in the US Senate. In addition, there's something that I call the Christine O'Donnell problem for the Republicans. Back in 2010, President Obama was in office. Joe Biden was his vice president. Joe Biden had been a longtime senator from the state of Delaware. So he left that seat in Delaware, and that means the Republicans had a chance to replace him. And they had a great candidate. They had a guy named Mike Castle, a former governor, a member of the House of Representatives from the state of Delaware for many years. The people of Delaware were very familiar with him. It's not like California. In Delaware, you only have 1 member of the House of Representatives. So when you get elected as a House member from Delaware, you're being elected statewide, just like a senator, just like an attorney general, just like a governor. You have name recognition through the roof, and he has evidence of popularity, given the fact that he's been reelected time and time again. And so the Republicans, in their infinite wisdom, decided to squander that seat by not nominating Mike Castle and instead nominating Christine O'Donnell, who nobody has ever heard of since. She went on to lose that seat by 17 percentage points. So frankly, I think the Republicans' prospects look so good for next year in the elections that they may end up nominating some weaker candidates and frankly, some kooks, and end up losing seats they otherwise could win. In terms of the presidential race, obviously we're a long way off here, but let me give you a 30,000-foot view. Yes? Oh, sorry, thought somebody was calling my name. So here's the deal. If Joe Biden wants to run for office again, he'll be the nominee for the Democrats. I think in the end, he probably will not run for office. And I think it's wide open. Normally, the vice president has pole position, but if you look at her ratings and the assessment of other Democrats, Kamala Harris is in political danger. And I think there are numerous people who might run against her. The one I get the biggest chuckle about, by the way, when I say Cuban, I mean Mark Cuban, the billionaire entrepreneur. But what I get the biggest chuckle about is Howard Stern. I mean, just as an American, I think we could all agree that a Howard Stern, Donald Trump presidential debate would be at least mildly entertaining. Quite vulgar, but mildly entertaining. In terms of Republicans, he's not going to get their nomination, chances are, but still, I have him on the list. He will seriously consider running. On the Republican side, there's President Trump. If he decides to run, he'll probably, not definitely, but probably be the Republicans nominee. I'm 50-50 right now. I really, he's the one politician I could never get in his head. It's so hard to figure out what he's thinking. If he decides not to run, then I think Ron DeSantis has the inside path. But watch out for Mike Pompeo, the former Secretary of State, former congressman from the state of Kansas. He's whip smart, graduated top of his class at West Point many years ago. He's lost 100 pounds. He's quick on his feet mentally. He'd be dangerous in debates. If I were to give the award at this point for the most underrated candidate on the Republican side, it'd be Mike Pompeo. Okay, so I think DeSantis would probably get the better of him, but Pompeo is definitely someone who could be dangerous. This is all depending on Trump not running. If either of these two fellows got the nomination, I think they'd pick Nikki Haley as the running mate. In terms of the U.S. economy, my theme for this year and next year, glass half full, glass half empty. For this year, we're going to end up with economic growth around 5.5%, maybe even 6%. Best year for U.S. economic growth for any year since the early 1980s. Glass half full. The glass half empty part is even with 5.5% plus economic growth, the U.S. economy at the end of this year is still smaller than it would have been in the absence of COVID. We're likely to get 6.5 to 7 million jobs this year when all is said and done. We're still waiting on data for December, obviously, just the last month of the year. Even with that, great year for job growth, we're still below par. We're still below where we were in February 2020 pre-COVID. I think the growth will continue at a slower rate, both GDP and jobs next year. Eventually, we should get back to par. In terms of inflation, I'm looking at 6.5 to 7% for this year when all is said and done. Next year, I think the Fed is right. Inflation will be lower next year. What they're wrong about is how much lower. They think it's going to be a lot lower. I only think it's going to be a little lower. I'm looking at 4% inflation with more risk to the upside than the downside for next year. Here's where I'm out of consensus. Okay, on long-term interest rate, I think we're going up to around 2%. So that's on par with the consensus, but I'm out of consensus on short-term rates. I think we'll only get one rate hike next year, and it will come late in the year. Now, the Fed is going to issue a dot plot tomorrow afternoon, actually tomorrow morning if you're on the West Coast. And that dot plot is going to suggest they're going to raise 2, maybe even 3 times next year. My theme for next year is simple. And I could be wrong about this. I'm not an oracle. My theme for next year is simple. Policymakers are willing to raise rates, but the flesh is weak. Personnel determine policy. And what I see at the Federal Reserve, what I see going on in terms of the personnel changes that are being made, are moving the Fed in a more dovish direction. We had 2 Federal Reserve Bank presidents who recently resigned due to trading scandals. Bob Kaplan from Dallas, Eric Rosengren from Boston. They were on the hawkish side. I think they'll probably be replaced with maybe 1 hawk and 1 dove. We had Richard Clarida, the gentleman who hired me to the Treasury Department about 20 years ago, who is vice chairman of the Fed. He's leaving at the end of January. We have Randy Quarles, with whom I worked at the Treasury Department. He's the head of, or was the head of regulatory supervision. He's leaving at the end of this calendar year. Both of those gentlemen are on the hawkish side, and there's 1 pre-existing vacancy at the Fed. I add that up, and I think the Fed may have a more dovish tilt next year than people anticipate. So I could be wrong about this, but I think they're, in the end, they're going to chicken out and only raise rates once late next year. In terms of questions, I'd love to stick around. I think I've left plenty of time for those. And if they want to be organized, I'd be happy to delve into those shortly.
Okay, we have a couple of questions. Anybody have any other questions? Send them on in. I did check off the list of questions that were already answered, I believe. Bob, do you mind shutting off the screen share? Sorry,
Sure.
So that way, just in case I see anything else come across.
Sure.
Okay, so I took off the questions that I think you already answered that came in advance. So if anyone feels their questions weren't answered who sent questions in advance, also please put them up so that I can see them. This one actually, you touched upon it towards the end. What is the risk the Fed will not act quickly enough on interest rates and inflation becomes worse?
Okay.
And this is probably a resolved conversation I've had clients before, is that the punch bowl story, which for those of you who haven't heard it, you'll hear it after this. But I'd like to hear your thoughts on it with your experience and your background there in Washington.
Okay, so my view is that the Fed, as I just laid out, will be too slow in raising rates. However, inflation is still going to be lower next year. than it is this year. And here's why. We're still going to get, in my view, energy prices to increase next year, but they're not going to rise as fast as they did this year.
Mhm.
Supply chain issues will still exist at the end of next year, but they're not going to be as bad as they are right now. So, for example, we might actually see used car prices and maybe even new car prices flat to slightly down next year. Seriously, because the supply chain issues in that particular sector have been horrific this year, driving prices up even more, even faster than overall inflation. So I actually think those might be pushing downward on inflation, not downward on overall prices. We're not going to have deflation. I'm just saying we're going to have inflation at a slower rate. The biggest source of inflation over the next year or so is going to be rent increases. Housing rents are going to, I think, really go up quickly over the next couple of years. And that's also why, even though I think inflation will be lower next year, let's say getting down to the 4 to 4.5% range, I think we're going to stay in that range for the next few years at least. That we're not going back to that 2.5 or 2% Federal Reserve target anytime soon. So I do think the Fed will be too slow, and I think inflation is going to be persistent and much more stubborn than the Fed now anticipates.
Okay, two more questions, but one popped up. How come we can't see you?
Great question. I have no idea. I keep on pressing start video, and it says you cannot start your video because the host has stopped it. So I'm sorry.
Okay. We'll go
I
talk.
would have
We'll
done
talk,
this from the beginning.
we'll talk to the host about that. I'll see if I can override it. Okay, I'm going to give you your next question then. What will be the effects on the economy if the Republicans take the House and the Senate in 2022?
Great question. So for the short term, nothing, because no policies can be enacted as long as the Democrats control the White House. If the Republicans have the House and Senate, the only policies that will be enacted are bipartisan policies. That's it. So for 2023 and 2024, the economy might be different than it is in 2021 and 2022. Okay, it almost certainly will be in some form, but it won't be the Republicans taking credit or taking blame, because they will have no power to, they will not have sufficient power to override Joe Biden's veto.
Okay, and this I think is actually for both of us. What are the biggest risks you see coming in 2022?
Wow.
And the kind of follow on to that was, where should someone invest or not invest? But perhaps, since we can't give specific investment advice, just a high level, where is the biggest risks to your forecast?
Wow, great question. So, I mean, we're bullish for next year on equities, generally speaking. I'm not the sector or thematic guy at First Trust, but we're bullish on equities. We think the stock market will be up around, maybe about 12% or so from current levels at the end of next year. But that's not quite as bullish as we've been the past few years. I still think the market is relatively cheap compared to alternative investments. I think long-term interest rates move up a little bit. In terms of fixed income, the real smart guys at First Trust who go sector by sector, they like high yield fixed income, because we think the economy will be okay and it'll get you a little boost compared to some other fixed income investments. In terms of the biggest risk, in terms of the biggest risk from my forecast, I would probably say that inflation outstrips my expectations by a lot. That's possible. Okay. Again, it's not my base case. If it were my base case, I already would have discussed it. But if inflation is even higher than I anticipate, that would be very negative for both stocks and bonds.
Okay. All right. My personal request is send us a picture of you so we can post it when we replay this. I looked at the system and I'm not sure why we can't see you. However, I'm not the one that sets these up, so we'll get that corrected if you send us a great picture of yourself. Yeah. The final one, and this question is not specifically to you or I. However, I'm going to ask you, and then I'll give, of course, my take on it afterwards. Is the question that on everyone's mind? What are the risks? What are they, or are there any risks regarding COVID and variants from an economic perspective?
Wow, great question. Okay, up front, I'm not a doctor. I'm not a medical professional of any kind. I'm not a scientist, not a vaccine researcher or anything like that. My belief is that we're going to move in the direction of uh, uh, having an annual over the next few years of having an annual COVID-related shot, just like we have an annual flu shot. I don't think they'll be mandatory. I think the push for mandatory vaccines is probably not going to go through and not approved in enough areas to really lead to any sort of widespread improvement in vaccine rates. I do think different states will have different approaches on masking. Obviously, California's approach will be a lot different than Florida's, and the trade-offs are different. But my expectation over time is mask mandates will diminish as well.
Okay. I think that is the biggest questions that we had here today. I want to thank you very much for your time and your overview and whatnot, and I'll follow up with any additional questions that come out there. Appreciate that because people hear from me a lot. It's nice to hear different viewpoints. You have your feet on the ground out there in Washington, so you can see things that we don't see, including, what the news says, and of course, what's really happening. So we really appreciate your clear-headed viewpoints and your knowledge and expertise today, and your time as well.
Thank you. My pleasure.
Okay, well, I'll thank both of you, and I'll finish up the last half an hour, and yeah, just send us over a picture and have a chance. I just saw you right before this, so I don't know why I don't see you today now. So, but thank you. Okay, everyone, thank you for hanging out. Hopefully everybody can see me okay. I can see me. That being said, I wanted to touch upon a few of the topics that Bob brought up, as well as some things that were on my agenda today. For those of you who are new to this, because I know we have a lot more registrants, the registrant levels are peaking pretty high, even if everybody doesn't make it live to the webinar. So I feel like I have to explain things for the first time again, just not to confuse people that are new to this. At the same time, I want to also be sure to cover a lot of topics. I'm going to concentrate more on the details of this and a really deep dive into 2022 and all kind of the sectors and areas on the January webinar. For now, though, I'll talk about the most important things. Interestingly, while we collaborated just before this webinar, just to make sure that we had who was going to speak first and everything on, we didn't talk about our views, and there's a lot of similarity between what I'm seeing with all of my research and my work, and also what Bob said, excluding all the Washington stuff, because I really have no idea what's happening in Washington outside of the economic policy. One thing that I wanted to touch on, because there was a lot of questions around this, and these questions came in really about a week or so ago. So now a lot of this has been answered, but there's been a lot of questions around COVID and the economy with the new variant coming out. Are we all going to lock down again? Et cetera, right? Especially hitting around the holidays. From an economic perspective, it doesn't appear to have much of an impact now. It appears to be, and I'll also give the same disclaimer, I'm not a scientist, I'm not a doctor, I'm not a COVID expert. Speaking as an economist, it appears to be that the new variant is more contagious and far less deadly. That is the usual trajectory of a virus. It becomes more contagious and less deadly over time. It seems to be following that timeline. In addition, Pfizer has gotten more data, more research, and which they just submitted to the FDA regarding their, I call it the COVID pill. It has around 89–90% effectiveness in keeping people out of the hospital if taken in the beginning of the process of getting COVID. So that's a therapeutic or a treatment in addition to the vaccines and the boosters over time will likely make COVID less of a reason to lock down the economy. I clearly understand, and we saw that just recently with California reinstating their mask mandate again, is that states and municipalities and countries will all treat this differently in different periods of time for a lot of different reasons, which brings up the economic factor. I've been tracking for a while now economies by states to the data that we can get to see what is the difference in the economies of states that are open. I'm going to use Florida for an example, with very few COVID restrictions, and states that are more restricted, for example, California. And it turns out that while there is a big impact on a lot of areas like tourism and leisure activities and whatnot, with more lockdown states, people are doing less of it. than more open states, which are getting more of the tourists, more of the conferences, et cetera. It doesn't matter tremendously for now because the extraordinary stimulus that the federal government has pumped out to the states, extraordinary amounts of money. California, I joke about this, is sitting on more money than God right now. They're not getting it because they're getting a lot more tax revenue. They're getting it because they're getting it from the government. And that has put them in a position where the hit to the economy with COVID restrictions is less of an impact from a revenue standpoint than it would have been in other times. As long as that money continues to come, then it's not going to be a pressing point for, say, California to say we need to open up. They'll do whatever they feel is best. Maybe it's health, maybe it's political expediency. I can't speak to that, but I expect that there will be states that are going to continue to be very restrictive. It will have an impact on people's desire to travel there or leisure there, and other impacts on the economy, businesses and whatnot that may move out of state or be less productive. But on a state level, it doesn't make as much difference. The second part of that question was, kind of alluded, is that the right decision, wrong decision? No idea. I wish the politicians followed the rules that they put in place, but I certainly can't speak for what's the right decision. Ultimately, only time will tell. So from an economic perspective, though, the bigger issue is not so much COVID, it's the extraordinary amounts of money that have been pumped into the system, which has created the problems we have with inflation. Yes, the supply chain and every aspect of the supply chain is being significantly affected right now by what's going on, right? It's a shortage of labor, it's a shortage of vehicles, it's a shortage of capacity in the ports and whatnot. But there's been so much money given out that our demand didn't go away. You can see it in the economic data. This extraordinary GDP, the extraordinary growth we experienced this year, then the end of last year, is almost unprecedented. It's happened before in history. All this money pumped in 2020 and in 2021 has driven up the amount of money in people's pockets, which has put personal incomes collectively in a nation, not everybody's, of course, at all-time highs, but personal savings rates at all-time highs. Demand is skyrocketing, which again puts even more pressure when you don't have enough labor force or capacity to process through the supply chain. All of this is a direct result of the fact that our M2 money supply is 49% or so above where it was pre-pandemic. That is all the extra money sloshing about in the system. And there's a proposal in place right now to put even more in, significantly more money into the system. This is when things start to run hot. This is what's creating this inflation. There is a very real risk the Fed will not be quick enough to try to tamp down inflation. Why? It's hard to take away the punch bowl when the party's going. So think about it this way. You're the host of a party and you want your guests to have a great time. So you put this glorious punch bowl full of liquor out there for everybody to drink, and everyone's drinking, everybody's having a good time and this and that. A responsible host knows when it's time to take away the punch bowl. They know when to do that, because if not, that good time that everybody's having, the laughter, the joking, happiness, quickly gets into pretty bad situation. People become really intoxicated and bad things happen. So knowing when to take away the punch bowl is the right thing to do, but it's hard to take away people's fun when they're having a good time. So very much the same thing. There will be, it will affect companies, it will affect individuals. It's going to have a big impact on certain sectors, say real estate and whatnot, as rates start to rise, as the Fed does what they need to do to start to tamp down inflation. Inflation is going to run hot. I fully agree with Bob. It's going to be much higher. Even if it goes down a little bit, it's not going to go down a lot. It's going to be high for the foreseeable future. This is baked in. It's going to be an ongoing situation. But the Fed's ability to take that punch bowl away at the right time is critical. They've gotten it wrong, horribly wrong in the past, and they've also gotten it really right in the past. So that's the key, and that's the thing we're going to watch, because much of these projections can be thrown off if they don't stay on top of that. The other thing is it's an election year, and it's going to be really important for the Democrats, as he mentioned. They have a risk in their ability to maintain power in the midterms. It's going to be very important that the average American feels good with their leadership. And what the average American decides on is not usually the political talking points. It's more so how they personally feel. So keeping inflation under control and keeping the economy growing and doing well for the majority of people is going to be a big target for the Biden's administration, as well as the senators and the Congress people that are up for re-election. Another thing to keep in mind is the stimulus. A lot of the stimulus have been sent out to people has gone away. All right. It's still higher than it was, but a lot of it's gone away. People are spending down their savings. And that often gets a lot of news. It's like people are spending down their savings. They must be in trouble. There's a significant portion of our country, probably no one listening to this call today, this webinar today, but there's a significant portion of our country who actually don't go back to work until they spent all of their savings. So rather than saving it, putting it aside for a rainy day and then getting back to work as soon as possible, they'll go back to, oh, I'm out of money. It's time to go back to work. There's a lot of people that do that. And because of that, as the stimulus money, these stimulus checks and a lot of this other has been spent down, it pushes more people back to work. So the question of that is why are the unemployment numbers so high? Why is the labor force the way it is? 10,000 people a day are turning 65 and focusing on retirement, or as we call it at Sequoia, the work optional lifestyle. You no longer have to work for money anymore. Why work? Tied to that is rethinking of life. What's important, where people want to be, what people want to do. I've never in over 30 years of doing this had this many clients rethinking their financial plan, rethinking their life plan. That's the one thing that's come out of this pandemic and this lockdown is a lot of people reconsidering it. So that's caused people to change, retire earlier, go work optional earlier, right? Say, okay, I can make it on what I have. I'm done. I'm out. And this has pushed a lot of this pressure with having the demand is so high, but there's not a lot more people wanting to go back to work. They don't want to, they don't need to, and they're not going to go back to work. Depending on what happens with Build Back Better, and if it passes, there will be even less incentive potentially to go back to work by such things being provided as free childcare. So there are many people that work. Part of the reason they work is to pay for childcare. If that's no longer important or necessary, do people go back to work? Does one partner work and not the other? These are things that we won't know until this happens, but it's likely. So the pressure on the labor force, the fact that there's not enough people to fill the jobs, that's going to be a long-term issue. That's not going away anytime soon because of demographics, because of the shifts around the pandemic and the lockdown, and because of the potential necessity not to work as much or not as much necessity to work. So definitely wanted to bring that one up as we go to 2022. Next year will be a growth year. It will be more subdued, much more subdued than this year. At this point, what we're watching is do we have what we call a soft landing from the tremendous stimulus that was put out in the growth of the economy, or a harder landing? Okay, we don't know yet. It is highly unlikely that we will see a recession next year, highly unlikely. The last recession we had in 2020 was the shortest one on record, I believe, and it literally lasted the entire duration of a technical definition for a recession, which was Q1 2020, because of the huge drop off in March when everything locked down, Q2 in 2020. By the second half of 2020, we were no longer in a recession. Very short, sharp, short. This time around, it's more likely that we'll see a slowdown, and it looks to be that the next recessionary period will be later this decade. Too soon to tell, probably not next year unless they get policy horribly wrong. The Fed or government policy or things that are put through, so it's not likely. However, slower growth, it's going to be really important to know what we own, more volatility. Okay, we didn't have even a 10% correction. Well, knock on wood, we still got 2 weeks left. We didn't even have a 10% correction this year. We had extraordinary growth. That is really abnormal. Expect more of that. Expect we might even get a really meaty 20% correction. It doesn't look good when you log into your portfolio, but it is part of the process, sort of the pain that you put up with to have that growth over time. If that idea is uncomfortable to you, please reach out to me and make sure we're properly allocated before that time comes. Let's see, I'm going to cover more questions here. I did want to mention something. This is probably more applicable to my clients rather than the guests today. It was an extraordinary growth year. It's critically important for me to rebalance portfolios properly. You could, some of you could see some tax effects of this as you do your taxes come early next year. I've done my very best to minimize the taxes as much as I can, but at the same time, ultimately, the integrity of the portfolio is most important. So that applies to you with taxable accounts. questions, reach out to me. I will answer that. But I just wanted to group, I'll say somewhat of an apology. I mean, it did come from a good place, but it still is a potential there. The other thing, and I get lots of questions about real estate often, and I'm not qualified to answer detailed questions about real estate. Something that Bob mentioned was something I was going to talk about today, which is rents and owner equivalent rents, which is kind of another way of seeing the price of housing, is going to continue to go up next year. A lot of the rent increases were slowed down due to what was going on with COVID and a lot of the restrictions there with the ability to collect rent and whatnot. That is going to start to pick up again next year. So expect that you're going to see rents increase and raise higher if for those of you renting as your leases come up. Also expect that housing prices will much more slowly grow unless the Fed gets aggressive with interest rates. If so, the rise in mortgage rates will probably impact the real estate market more than anything else that's going on. That's my high level. Oh, as always with real estate, it's very important to speak with your financial planners. Okay, if they understand this as far as your plan, and also your real estate professionals, specifically with whether it's a good time to buy or not, and in which markets, because those questions, again, I'm comfortable with the economics, not comfortable with the investing aspect of specific markets. Okay, and I'm sorry, I'm going to look really quickly here at my notes to see if there's any other high level things. Next year, GDP, very much in line with what you're saying, 3-4%, unless there's some major change in government policy in there, more volatility in the markets. One thing I wanted to bring up that, again, comes up a lot with this is government debt is a question we get a lot about. How much is too much? How much debt can we take on as a nation? It is a really big issue. And it's one of those things is that when it becomes a problem, it's almost too late to fix it. So we as a nation, politicians think short term. They think about the next election cycle. If they're not running again, they're doing it for their party. And that's kind of the cycle. So a lot of policies are put in place are not really thought out long term. That's why it's hard to get major structural long term change done, is because of the shorter term thinking of the next election cycle. The debt levels, they're getting increasingly more, the government, not really upfront, I would say, with us about it. The Build Back Better plan is a really good example of that, in the fact that they have some of the really popular policies and really popular programs in there, like free childcare and the like. They sunset in 1 year. So who is going to do that? Now, here, free childcare for 1 year. The next person who's in office is almost certainly going to extend that. So the cost of these programs are often much higher than what they say at the time they're passed. Why? Again, long-term, short-term thinking. Now, I know politically we all can debate about which are the right things to fund and not. And I'm not by any means saying that it's a good or a bad thing. It's just the costs in it. All of this runs up the debt, and it works if our economy is growing and the government's bringing in plenty of revenue, but it really makes things difficult during a downturn. And also our ability as a nation to sustain the debt. Another thing is how prepared are we for the next big event? Okay, the next event that all of a sudden we have to make major and sudden changes as a nation. Maybe it's something coming from overseas, another viral outbreak, a pandemic, a terrorist attack, whatever it may be. The more debt we hold, the less ability we have as a nation to adapt to major changes. Our ability to get through COVID economically better than any other country in the world was exactly because of how we're structured. Our interest rates were low, there's enough debt, there was enough things that the Fed and the Treasury could do to help sustain it. And even, I would say, in some ways, make things stronger. That our ability to do that, there's diminishing returns over time. Each time that we have to stand up, it's just not easy for the politicians to tell people, hey, we're going to have to do less of this because it's getting very expensive. We need to cut back. It just doesn't get you elected or reelected, and that's a challenge that politicians have there. And also, when you provide services, so I'm going to use childcare as just the example here. Again, I'm not taking a position of whether it's a right or wrong thing. Everything has its trade-offs. It affects the economy in other ways as well, right? If all of a sudden a service is free, do we have the infrastructure to support all the new people that will be using this service? What are the impacts that it's going to have in the short term and in the long term? And we saw this with college. When college loans were made easier to get, I think it even started back in the 60s or 70s with some government programs. when it was easier to take on debt to go to college. The idea was wonderful, a better educated workforce, more people with greater opportunities to go further with their careers. Let's get everybody to college. Let's not make money an impediment to doing that. Here's loans. What that did is that there's still only so many colleges and places to go to higher learning. It drove up the costs. The more people that can go, the higher the costs are. And so the cost of college has gone, in some cases, almost twice that of inflation. And any of you who have put kids or helped to put grandkids through college, you know that the costs are skyrocketing. It's one of the biggest challenges to people in their financial planning is paying for kids' college. But it was a direct result of a lot more people were given money to be able to use a service, but the infrastructure wasn't there. And so the costs rose. Would that same thing happen with childcare facilities? Only time will tell. So these are the trade-offs that we will be adapting to as more policies are put in place. The other really big question I had was around the conflicts that are happening overseas, specifically with Russia and the Ukraine and with China. I'll touch upon those briefly. Russia and the Ukraine, from an economic perspective, is not something to be concerned about at this time, unless, of course, it escalates beyond that. The challenge there is Ukraine has been moving, I guess, westward, looking for NATO, to join with NATO, looking for EU support. Russia does not like that idea of having NATO right next to their back door or right there at, on their border. And so that's their concern. I'm speaking very high level about this. I'm sure there's a lot more details. Remember how the US responded when the Soviet Union wanted to put the missiles in Cuba? That was a little too close to us for our comfort. And that led to probably one of the most dangerous moments in the Cold War, where we could have actually gone into a nuclear war situation. Fortunately, it was resolved, but you have to imagine how the US felt when the Soviet Union was going to put missiles in Cuba is very much how Russia feels about NATO putting bases or weapons there in Ukraine. Also, Ukraine, like many countries out there, is not a homogenous ethnic group, or ethnic, the right term there. The eastern half of the country are Russians, the western half Ukrainians. They historically have not gotten along with one another. So there's a lot of similarities to the Ukraine as a country now, as was Yugoslavia before the East Bloc fell, where you had the Croatians and the Serbians. I believe the Serbians were the dominant group, the Croatians were not, and there was a great deal of conflict there, and eventually it was split up. I apologize for any errors I made in the history of the geography of that. Hopefully I was giving a high level of the conflict there and how it's likely to play out. I don't know. It just really, I think, depends on how much NATO pushes to be part of Ukraine, how much Ukraine brings that to what Russia's next steps will be, not from an economic perspective an immediate concern. China, on the other hand, is something Bob said was very telling, and this is something to watch, is Biden undid nearly significant amount of Trump's policies when he came into office. He just undid them, didn't like them. There are some of Trump's policies that he's kept, which means there's a reason for it, right? And one of it is China is our single biggest economic threat to the United States. At some point, maybe a military threat as well, but economically, it's our single biggest threat. They're actively expanding their influence throughout the world. A big inflection point is going to be what happens, of course, with Taiwan, but things could come up sooner. So there's a lot of more consideration economically about a relationship with China and how that goes forth. And that's something we're going to want to watch really closely, because that was, again, some of the other questions that came up. So there's no new questions, so I'm going to check this very quickly. So this is your last chance if you want to shoot anything over. I think I covered it. Let's look at the very last ones here. Oh, a lot about the government spending, how much is too much. A lot more on the political one. Okay, risks in 2022. Close out with that. Biggest risk, as I mentioned, is the Fed is not aggressively staying on top of inflation, and inflation spins out of control, which gets far worse. There's a lot of things that can trigger that. And if they don't aggressively stay on top of it, it's very, very, very hard to get rid of inflation once it's taken hold. And I mean really meaningful inflation, greater than we have now. So if it starts to spin and action's not taken right away and it becomes entrenched, the only way to solve for that is to really do significant events with raising rates and other economic activities that which will slow our economy down and create a great deal of pain, not only in your portfolios, but in most aspects of your life. We saw this with Volcker had to do in the 80s. This could very well happen again. That is a risk. I'm going to put China aside right now because that's going to be an ongoing risk. The other one, of course, is government, I want to say overreaction or strong reaction to COVID, where we continue to lock the economy down or do anything around that. I think that's less likely to be a case over time, but it's always theoretically a case of it. A big one is, again, we keep piling on a lot of debt. We don't try and stay a hold of it. Then we have a major conflict or a major event in which the government has to come in and spend a great deal of money very quickly because of something that can't be stopped. Okay, a lot of question I get was around climate change. Actually, there's no way to model the economic risk around climate change because we don't know what, if anything, is going to be done about it. So there's two roads to that. One road is, what do you do in advance, to try to minimize or prevent it? Can we even do anything? Nobody knows. It's all theories at this point. The second one is, what do we invest in our infrastructure to prepare us for it, right? To basically prepare us for the change so that our infrastructure and everything around that is done. That's a cost where you can have a better sense of it. In other words, we cannot or will not make any changes, so we're just going to adapt to it. What's that cost? That's going to take time to really understand. So I can't really model that out effectively from an economic viewpoint. And the other one is the consumers. The consumers got used to a lot of money coming at them. Okay, costs were rising rapidly, but a lot of money. That's diminishing, and it's diminishing. The personal income is actually diminishing at a pretty good clip. It may stabilize, but if it continues to decline, where people just spend down, they don't have money, they start racking up a lot of debt, we'll likely go into a recession. That is something that's very real, and as the year progressive, I'll be able to track that better and be able to give you probably a better sense of it. So I hope I've answered at least some of the questions on a high level. Again, we'll get into this more in January. Please continue to send your questions. Please continue to make suggestions for topics. I have access to a lot of really great speakers. Okay, so if there's a topic you want, don't even have to have me talk about it. I'll bring them in. I tend to do better on individually than on this big group because I never know what everybody wants to hear, and there's so many good things going on. At a high level, next year, much more modest growth, much more volatility. The news will scare the life out of you. If you find yourself being stressed, turn it off. It's not good for anyone's health. I have to pay attention because it's my job, but you have me to pay attention to it. The news will always tell you it's the end of the world. As we transition into this new year, think of the things that we're thankful for. There's always things to be thankful for. Focus on that. Perhaps, of course, it's always my dream that we can get along better as a nation, less politics, partisanship, separation, and divisiveness, and more caring for our fellow humans. Does it change anything? Who knows? But we feel a lot better when we do that, a lot less stress. A lot of these issues that I brought up today it's not designed to put you in fear, put you in worry, or put you in concern. All things can be adapted to, adjusted to, and planned for in respect to everything I've talked about today. There's always something to be worried about, and there's always something to be optimistic about. Focus on the things that make the biggest difference to you and what you can make the biggest change with of value to you. For those of you who are tuning in for the first time today or don't know me personally, don't hesitate to reach out. If you mention you're on this call, I will answer your questions. The other thing about a big webinar like this is that individually you can get more granular, can be more specific in advice and recommendations and answering questions. On a broad format like this is sometimes harder to do that, not knowing what that is. So don't hesitate to reach out, and I can give you also the facts, figures, and data or anything I've talked about today, as well as something a bit more customized. So I would like very much to wish all of you happy holidays, Merry Christmas, Happy New Year, to whatever you may celebrate and wherever you may be this year. I'm incredibly thankful for your confidence and trust that you've had with myself and our team during a time of tremendous change and transformation. and things that we probably never thought we'd experience in our lifetime. My gratitude is infinite towards all of your confidence, and I will continue to monitor things. I will continue to watch things and make adjustments as conditions warrant. However, I'm as good as our last conversation, so please reach out to me anytime you have a question, an update, or a change. Thank you all very much for attending, and I look forward to seeing you in the new year. Okay, bye for now.